So what is the best investing strategy for 2024? Dividend Gold investors, bonjour. My name is Mike Yahoo, and I'm the founder of Dividend Stocks Rock, and I'm also a passionate investor. I have this YouTube channel to help you invest with more conviction so you can enjoy your retirement. And to do that, well, you must find a strategy that sticks within your values, within your investor's profile, and that you feel good about it. But every single year around January, I get bombarded by emails and questions about, yeah, Mike, what do you think about this strategy? What do you think about this guy? He's doing this. He's very successful. So what's up with all of those strategies? I don't know if it's because it's winter time, the holiday's over, so you feel kind of bored and you're just like looking through all kind of strategies to make your portfolio better. And of course, we want to make good returns, right? That's the sole purpose of investing, is to make more money. So the hard work, earned money that is being invested is actually working for us so we can achieve our financial goals. And for most of us, it's to have a very comfortable retirement. But then chasing the yield, chasing the return could be a dangerous place. So today we're going to look at various strategies. I'm going to let you know my thoughts about them, and then we're going to end up with my strategy and the number one most important thing when it's time to select a strategy and to write up your investment plan. We're going to end up with this thought. So let's get started with the Beat the TSX. Beat the TSX is similar to the Dogs of the Dow, but with better results. If you have been looking at the financial literature about the Dogs of the Dow, so you're just basically buying the somewhat weakest performer of the past year, so with the highest yield, and then the next year it's getting a lot better because technically they were oversold, and then they're going back to the market, and then you just rinse and repeat every single year. So you're always after the dogs. So the dogs the next year should be outperforming the rest of the market, and then you sell those dogs and you replace them for the new ones for the new year. The Dogs of the Dow, it's somewhat interesting, but not as the Beat the TSX. Beat the TSX has the exact same strategy. So they're using the TSX 60, so the 60 largest companies by market cap. And what they do is every single year at the beginning of in January, you look at the top 10 high yielders and you select those, and then you're just thinking, okay, I'm all good, and I'm going to let that run for the full year. Interestingly, for the past 30 years, the Beat the TSX has beaten the TSX, as reported an annualized growth rate around like 10% over the past 30 years, which is kind of amazing, right? So if you're thinking about investing somewhere and you kind of like find a strategy that deliver double digit almost every single year, that does better than the index, sounds like a very appealing strategy to me. However, I just pulled out the dogs for this year and looked at what happened over the past 10 years, in the past 5 years. And what you can see is they're not doing that great. So the thing with the Beat the TSX is you have to sell them every single year to replace them with the new ones. So sometimes from one year to another, you're going to have a few companies that will be the same. But if you're doing that in a non-registered account, you're going to end up paying a lot of taxes. The other thing is you must need a lot of faith in that strategy, because if you're just doing some small modification, well, you're obviously not going to get the same results. So going after 10 stocks is highly concentrated. If you look at this list, we have a few banks, we have pipelines, we have telcos, and that's pretty much it. So basically you're condensing all your investment in like 3-4 sectors, hoping for the best. I'm not that convinced that it is a long-term strategy, in my opinion. And while the Beat the TSX does beat the TSX, beating the Canadian market over the past 5 and 10 years has not been that difficult. Actually, a good way to do that is just to open your portfolio to some US investments. Another strategy that gained way too much popularity in my mind is the covered call ETFs. A lot of people are talking about those, and I decided to pick my perfect example. Why? Because this one is very, very easy to track. It is the BMO tracking the Canadian bank or doing a covered call on those same banks. So exactly the same investment. You have like two strategies. You hold the assets, plain and simple, or you go and you do covered calls on them. Technically, the covered call ETF should do better during a downturn. So when banks are going down, well, technically the covered call ETF should do better because you're actually earning a revenue by selling the option on top of getting the dividend and on top of like seeing the stock price in this case going down. But what's interesting is even during downturns, the covered call ETF is not able to outperform the regular banks. Even worse than that, what you see there is the past 10 years. That's another reason why I took this one, because you have a long history, so long track record to see what's going on with both. Well, you're leaving a lot of money on the table. We're talking about almost 50% of returns that you leave on the table if you go for the income solution. So I get the idea. You want to have a higher income. It makes great what I call napkin calculation. So you just invest $1 million, you find a product that gives you 5%, and then boom, you have $50,000 a year in income. That's great. But when you think about everything that you leave on the table to get that income, you might as well just get the dividend from the banks and then sell a few shares every year, and you're going to end up with better results. As you can see, almost 50% over 10 years. Imagine if you do that for your entire portfolio. That could make a world of a difference in your budget and how much you can actually spend and how much you're actually going to leave to your spouse, to your children, to your grandchildren. So this definitely deserve a little bit more of your attention. You just have to be a bit more careful about that. So it's not that covered call ETF are the worst product ever. They work, they generate the income that they promise, so that's great. But in the end, you're not making that much money compared to the exact same strategy without writing the calls. Now we're going to move on to what I would say is probably the best investment strategy for most investors, and it's investing in ETFs. Mostly, I prefer index investing, so you can create a very good portfolio with a few ETFs, or you can go actually to an all-in-one ETF that offers you everything that you need according to how you want to invest. And on top of that, it will be rebalanced every year. So that's great because you keep the same strategy. You don't have to do anything. It's like you get the keys and everything is done for you. What could ring some confusion here, though, is the incredible amount of choices that you have when you decide to invest in ETF. On this graph, what you see is the classic, just plain and simple S&P 500 SPY, which works very well, right? Over the past 10 years, 226% total return. Then I added an ETF that focuses on dividend grower, which is the Schwab US Dividend Equity, which is one of like the most famous and one of the best performing as well. So almost as good as the S&P 500, but the S&P 500 has something in its pocket right now, and it's called the Magnificent Seven. So we have a bunch of technology stock that don't pay a dividend or pay a very small dividend that drives about 2/3 of the stock market return last year. So we count Google, Nvidia, Tesla, Meta, Amazon, Apple. So those big guys that are offering a lot of growth, and Microsoft, sorry, I forgot Microsoft. A lot of like either low yield, high growth stocks such as Microsoft, Apple, and Nvidia, and all the others are not even paying a dividend, but they're all about growth, which you're not going to find much in the Schwab US Dividend Equity ETF. And then there's another kind of like trend, I would say, and it's called factor investing. So that's been developed by academic studies, which shows that companies that are more exposed to the 5 factors are actually outperforming and doing a lot better, which kind of makes sense, which is kind of great. I already did an episode on that on a previous podcast, actually not on this show. But the thing that I'm not too sure about is how you can translate this into a real life investing strategy. So it's fun to look back and play Monday morning quarterback. It's a lot harder when you're trying to actually determine which are those companies that will be exposed to those factors and that will outperform. As you can see, the US dimensional US core equity total return lag behind the dividend growers and lag behind the S&P 500. So in the end, you have some academic studies to kind of like telling you you're doing the right thing, but you're performing well, but not that much. And as a bonus, I just wanted to show you another example of an ETF that is based on covered calls following the S&P 500. So while the S&P 500 as a plain asset generated 226% total return in this example, the Global X S&P 500 covered call ETF is at 87. I mean, that's a lot of money on the table. Again, it is generating income. It is not declining, so you're still not going to lose your money. But when you have the choice between A, buying the asset, or B, buying the asset with cover calls, well, solution A is always better. And then you have another proof right there. I just said that I think ETF are probably the best solution for most investors because for most cases, you lack of time, interest, or knowledge to manage your portfolio. So if you do not have enough time to spend, well, you're better off in that to a professional, pay a small fee on ETF, everything's being rebalanced, and then you focus on your strategy and you just invest, and that's perfect. If you have a limited amount of interest, well, it's even better because you don't really care about financial statement, you don't want to learn about it, and that's fine. But if you do not, well, don't start picking stocks for yourself because you're going to make huge mistakes because you will not be able to understand what you're doing. So it's really important that if you have time, knowledge, and interest, that makes sense to starting a portfolio on your own. If not, go with ETF. You're probably going to do much better results as you just have to put your money in and let it grow. This is a strategy that works. However, it's not the strategy that I prefer. Why? Mostly for one major thing is when I invest in an ETF, I needed blind faith because I need blind faith that the ETF is going to do well. And when it goes down, I cannot pinpoint what's going on because it owns like 50, 100, 200 stocks. And then you wonder, like, are those the real good stocks in my portfolio? Should it be better? Like what's going on? What's the problem? As opposed to when I look at my portfolio with like 30 something positions, when the portfolio is down, I can identify which stocks are underperforming. And then since I've done my due diligence, I can understand why they are not performing. And then I can make a decision to know, okay, are they still in line with my investment thesis or they're completely bogus? My investment thesis was wrong. I made a mistake. I made a bad choice. And now it's time to let it go and to invest in another one. I cannot do that with an ETF. I can do that with individual stocks. So my strategy is all about dividend growers, as you know. And the thing is, most of the stocks that I add in my portfolio are either showing mid yield, so between 2 and 5, or a lot of them are actually showing low yield, high growth stocks. And here's the thing that I like about this is a lot of income investing investors will tell me, but Mike, you like Alimentation Couche-Tard, it's going to take them 8 years of dividend payment to equal 1 year of dividend payment of Canadian utilities. So why would I care about ATD when I can buy CU and actually get 8 years of dividend in a single year of payment? But then when you look at the capital appreciation plus the dividend, so the total return, which really matters in any cases, well, then you realize that it also takes about 92 years of Canadian utility to bring in 10 years of ATD total return. I bet that your investment return horizon is not 92 years, right? It's probably 10, maybe 30, maybe 40. More than 40 could be a stretch unless if you're in your 20s or 30s. But then again, you're probably better off with a mix of low yield, high growth stocks and mid yield instead of focusing on the high yield. But that's just me. The thing is, for high yielders, they are mature versus or stagnating companies, which I don't necessarily want to have in my portfolio because I don't want companies that are one step behind their decline in my portfolio. I want companies that are thriving, that have a robust balance sheet, that have a lot of growth vectors and will continue to perform in the future. If you're curious about that, I wrote a complete guide called Dividend Income for Life that explain the idea behind selecting low yield, high growth stocks instead of going for the high yield. I make comparison. I explain you what's the logic behind the high yielders, what's the logic behind low yielders, and then I give you even a methodology for your retirees that are going to tell me, but Mike, I cannot retire on ATD. Doesn't make any sense. You know what? In this guide that you can download in the link description below, it's the Dividend Income for Life guide. In this guide, I explain you how you can build your portfolio using low yield, high growth stocks, and then a mix of medium yield. But forget about the high yielders and still retire stress-free with a very comfortable source of income, all that using this strategy. So you don't need to focus on high yielders. There are other opportunities. Now, before I let you go, the most important thing about investment strategies is obviously I'm going to tell you that mine is the best one because this is what I believe in, right? This is what fits within my value, within my investor's profile, and that helps me to reach my goal. But that may be not your case, and that is totally fine. What is really important is not to look back in the past and look at which one has outperformed the others. Of course, I want to have the best investment strategy for my portfolio, but I'm going to know if it was the best investment strategy in 40 years from now. And it will be a little bit late to call Marty McFly and go back in time, right? So instead, why don't you focus on having a clear strategy? So something that you can easily explain to somebody else. So that means that you are fully under control with your strategy and that has proven to work in the past. Not necessarily the best one, but if it works and you understand it and you are comfortable with it, well, that is your strategy. So it doesn't mean that it has to be low yield, high growth stock. It doesn't mean that it has to be ETFs. It could actually be covered call ETF if you prefer to get that income that provides you some stability and you sleep well at night and you don't really care about how much money you leave on the table. Well, that's fine. And that if that works for you, you should do you. And that is the most important advice I can ever give you. And this one could be really a financial advice is do you. Like make sure that you are 100% confident in your strategy. And then you never have to look back and look at what your neighbor does and how he's making it. Because it doesn't matter. In the end, if you reach your financial goals and you're not stressed about your portfolio, you have made it. So, all right, guys. Give me a thumbs up, subscribe to the channel. Let me know about your investing strategy in the comments. So we're going to discuss about which kind of investing strategy there are and which one do you prefer. And don't forget to download the Dividend Income for Life guide. And until next video for next week, don't forget to stay invested.